Hello, so let's take a look at a life insurance illustration to show numbers behind the concept that you've heard about using your money as a Freedom Reserve System banker. All right? So what we talked about was if you used $50,000 of your dollars, and that would have been an assumption that we had $100,000 in your account. I'm showing you an illustration right now at the 7th year. You've got $100,000 in your account. And this would go along with if you use $50,000, what actually happens to your insurance contract at that point. So this $100,000, they don't send you $50,000 of your money. They send you $50,000 of their money. And like I said in the last segment, that if you died with a policy loan against the contract, they would subtract that $50,000 off this $2.2 million. All right? Because you've already received the $50,000, right? So as this loan goes on, what happens in the next year? If I'm pointing at year 7, the $102,000 has a $50,000 loan against it. It grows the next year to $120,000, all right? It does that because your money didn't leave this contract. Your money is still in here. It's growing exactly like it shows. So the $50,000 loan is against $120,000 of cash. That would mean you'd have $70,000 of capacity at that point to go do another loan. All right? Anytime that you borrow money from the insurance company, they're going to charge you around 5% for the use of this money. That compound interest is in a non-structured loan. The mistake that so many people make is because we're all so used to when you set up a loan, you make payments based on what the bank tells you when you're going to make the payment, how you're going to make the payment, what you're going to pay them for the payment. See, they set up structured loans. But in an insurance contract, they will set up a structured loan if you want them to, but you have the choice and you have the control. See, you're the banker. You've got to get yourself in front of the bank board every morning when you go in front of your bathroom mirror. That's the bank board, all right? And you have to have a discussion with that mirror, and you have to ask yourself what you want to do with the money that you have in your Freedom Reserve Bank. If you decide that you're going to take a loan, you can decide when you're going to pay back, how much you're going to pay back, and you can decide what terms you're going to pay. Everything is in your control. So here's the ideal way to set up a loan repayment plan. It shares this system talking about an annual payment to the Freedom Reserve Bank with deductible interest at 5%. What you should do is you really should pay this loan back annually. You don't need to pay the insurance company every month. You should set up so your business is paying you every month. See, this business, you can do that through an automatic transfer. It just transfers from your business account as a loan repayment to your Freedom Creation account. See, that didn't involve the insurance company at all. I always want to encourage you to keep it simple. You don't need to have multiple loans going back to the one insurance contract or two insurance contracts or three or however many that you own. You need to manage this within your business paying your person. And at the end of the year, you can add up all the interest that you would pay the insurance company and do it with one check. You should always write one check for interest and memo it as an interest payment because it's a deductible interest to you because you took this loan from the insurance company for a business purpose. I'll expand your mind one last piece. You don't just have to do this as a business owner. You could do this from an investment perspective. Let's say that you wanted to own a piece of investment property. It's the same process. Anytime that you use your money for an investment purpose, it is deductible to you. So, put this program into place. Learn how your policy is affected by you taking loans. If I roll this all the way out, you can see that every time the money is growing, every year the money grows in your cash value, you have access to that much money. You did not have to wait until your 7th year to do this. You could have taken a loan in the first year, but you only had $9,000 to work with, right? But you could have taken a loan for $8,000 if you wanted to. You could have taken a loan for whatever amount is in your contract. You don't have to wait. The idea is that you need to understand capitalizing your bank is the most important thing you can do, because you're going to use money the rest of your life. Capitalize this bank not with how little you can put in, but with how much you can put in. The more money that you can build in these systems, the more money you're going to have use multiple times in your life. I hope that helps. Thanks for listening.